endeavor. Already we have told how you can do the intraday trade in a scientific way using the volatility, and also we have informed you how you can invest in the specific stocks using specific mathematical ratios for short-term investment, and many topics associated with the technical analysis, Elliott wave, Fibonacci we have taken, and all those topics recordings. Yes, past many years we are conducting this kind of events every month, 3 to 4 events. So if you are a serious learner, lot of stuffs you can get in our website. Under the video link of our smartfinancein.com, you will get all the links associated with different subjects. Some are in Hindi, some are in English, but all these techniques, whatever we taught to you till this point, are scientifically proven, scientifically validated. So today you are going to learn one of the best trading technique for the option strategy. So why we are forming option strategy? What is the necessity of becoming an option strategic trader? So whenever we are doing the trades in the option segment, specifically in the option strategy, we are giving optimum priority to our risk or the money management. The risk is being given optimum priority. Money protection or the loss protection is given the optimum priority. So that's why we are focusing on these option strategies. So gradually how the traders used to migrate, initially the traders, when they used to a beginner in the stock market, they used to do a blunder by entering into the intraday trade segment. When they used to lose money, that time they used to jump into the option segment because money is already eroded, nothing is there in the hand. With low capital, they used to jump into the option segment. However, I will advise all of you, those who are present today's webinar. So I will advise all of you, be an option strategy trader from the beginning itself. Intraday trades you can do, but it must be a low volume trade. Option strategy, if you are forming, you can do high volume trades and you can be protected in many wrong days also. So in this process, yesterday I have taught to you one technique for the money management, that is pair trading technique. Two stocks you are choosing and you are trading based on that. Today you are learning the option strategy. First we will be analyzing the trend of a low volatile market. Then we will be projecting the price congestion in the low volatile market, because we need to identify at which price range the stock or the instrument is going to move in this low volatile trend. And we have to form the option strategy with respect to the Greek neutral approach. So I will start my journey from the beginning, analyzing the trend in a low volatile market. So as I told you from the very beginning, in the Smart Finance, we never give any fake, non-scientific or non-mathematical conclusion to any of the facts. When we say about the low volatile market, we have a scale. Because we advocate, if you have a high blood pressure, then it has a number. If you have a high blood sugar, so doctor will not say that yes, you have high blood sugar, but I cannot say you the number. So like in the TV channels, some critics, they used to come into the channel and they used to say that it's a high volatile market, but they don't have a scale. So such kind of wrong information we never propagate in the market. So as per our view, the low volatility associated with the option strategy is less than 25% implied volatility of the option. If any option is having a implied volatility less than 25%, then we can say that that option is in a low volatile band. So whenever you are forming any strategy in the futures and options segment, you have to take the reference of volatility from the options only. So to identify the volatility behavior of underlying asset with respect to option, we need to take the average implied volatility of one in the money call option and put option and one out of money call option and put option together. So 4 different strike options we will choose. Out of that, 2 will be in the money in nature, 2 will be out of money in nature, and they will spread over call and puts. So that I will explain how we can derive the volatility of the underlying asset taking reference of the options. If this average works out to be less than 25%, then we classify the underlying asset to be in the low volatile trend. If it is above 20% and below 40%, then it is a medium volatile band, and above 40% it is high volatile band. This is only applicable for the option strategic trades. However, if you are trading only in the future segment, then the 20% band is the low, less than 20 is a low. However, in the option strategy, 25% band, less than 25% band is considered as low, because it is a derived instrument. That's why 5.5 grace points we have given to it. Then we need to identify the price congestion. So what is the price congestion? Already I have told you. What is the price congestion in terms of the option or in terms of the stocks also. So in the low volatile market, price moves in a small band, and that band is known as the congestion band. So the price will be fixed in a proper band, and it never used to move above that band, or one particular high and low is being set by the market, and the price used to move in between that. So that band is considered as the congestion band. Once this congestion band is broken, that time we can think of some renewed volatility will come to the market, or we can think some amount of greater oscillation may happen in the market. So this congestion is very, very important. So what are the processes available to identify this congestion? So Fibonacci principle says, if the congestion band is in the between 0.618 to 0.786 and congestion breakout happens above 0.88, 0.888 Fibonacci ratio. Gann principle says congestion band is 45 degree resistance and 45 degree support derived from the midpoint. And Elliott wave principle says the congestion in impulsive wave cycle is wave 3 starting and wave 3 ending. In corrective pattern, it is wave B starting and wave B ending. So these three different principles say three different things for the congestion band. So I will request all of you, since I allowed you to put the questions associated with the subject, please put it, but concentrate on my lecture. That is very important for you. Do not ask the question for the sake of asking questions. So three principles have told three different ways to identify the congestion band. So the band in which we should move in a low volatile market. However, as I used to tell in all my past webinars, Fibonacci method is a preferred method in the low volatile market because it provides or it produces more accurate result. So as per the Fibonacci principle, the congestion band is 0.618 to 0.786. So the retracement can go till 0.786 and from there it will again retrace back. So this phenomena will continue till the low volatility trend is intact in the market. So we'll see some examples also. Very simplest way I can explain these things in terms of an example. And once we identify the low volatile market, once we identify the congestion band, what are the option strategy applicable in that market? So as all of you know, those who are already the buyers of my book on futures and options, they will be knowing that there I have given 22 futures and options strategy for Indian market. One special segment I have created, 22 futures and options strategy I have given, which is suitable for Indian market. Out of those 22 strategies, so those 22 are the hybrid strategies. So we have some basic strategy, like some 36 basic strategies are there. Saddle, strangle, calendar, long calendar, credit calendar, debit calendar, like that with 36 basic strategies. And using these 36 strategies, we can form some billions of option hybrid strategies. One saddle, one strangle, one long straddle, one short strangle. Like this way you can form billions of hybrid strategies. However, in the low volatile market, these are the three strategy works very well. One, the net credit calendar spread, covered call with put or covered put with call strategy, long conversion with multiple put long with net delta negative or vice versa. Means short conversion with multiple call option long. So if you wish to, you can take a note of these three strategies. So these three strategies works out very good in the low volatile market. So we'll just go for the analysis. What are the theoretical concept I have told you? Same thing we'll analyze now, and same thing we'll discuss in terms of our practical point of view. So today Nifty future has closed at 5975. So as I have told you, 2 in the money options I will choose, 2 out of money options I will choose, and out of these options, so out of those options I am also taking the recording. If the quality comes good, then I will share with you. So here, so 2 in the money options, we have closed at 5975. So 5900 call option is a in the money option. 6000 put option is a in the money option. 6000 call and 5900 put, these two are the out of money options. And the previous two, which is 5900 call and 6000 put, are in the money options. Why in the money option? Because they have some intrinsic value, money value associated with that. So those options for February series is quoting at 121, 90, 65 and 48. This call option and put option already I have written here. So in this process, all these 4 different strike options has 4 different implied volatility. This values also you can get it from the NSE website. NSE website, in all option columns they are giving IV, implied volatility. I have taken the reference from this implied volatility. So I have taken these 4 different strikes, 2 from call option, 2 from put option, with the rule 1 call option will be in the money, 1 call option will be out of money, 1 put option must be in the money, and 1 put option must be out of money. Their implied volatility I have taken, and I have taken the average implied volatility. So this average implied volatility says 12.86 of the average implied volatility, which says the Nifty is in a low volatile band. Nifty is in a low volatile band, 12.86. 12.86, which is a pure low volatile band. Because we have a protocol less than 25, we will be considering it as a low volatile band. So let us take in the daily terms. So this is annual terms. So we are dividing it by square root of 365. We will get the daily volatility. Then suppose I wish to form some strategy and wish to hold it for 10 days. So I need the 10 days volatility. So daily volatility multiplied with the square root of 10. So we have not calculated the Nifty volatility, rather we have taken the reference of the Nifty volatility from option implied volatility. So 10 days volatility, we are going to form specific strategy and we are going to hold this thing. We are going to hold this strategy for 10 days period, and for that 10 days cycle, we are expecting the Nifty to move by 2.12 percentage from the level of 5975. So in money terms, how many points you can get? So if I will take in the money terms, so 5975 multiplied with this 2% divided by the 100. So next 10 days Nifty is expected to move by 127 points from 5975. So optimum you can expect, if you add this 127 with the 5975, you will get 6102. Minimum you can get 5847.79. This is the optimum expectation, highest expectation. However, this is a low volatile market. We may encounter the congestion in this. So congestion says, as per Fibonacci principle, from 5975, we will go till 0.618, means till 6053, or we may fall down to 5896. So we may oscillate in this band, 0.6018 band, 6050 to 5896. This is the congestion as per the Fibonacci principle, considering the low volatile market. Same way, if this value also penetrate 6053, again we have a very big congestion band, which is 6074 or 75 to 5875. This is the point which can saturate this low volatility condition. However, if it successfully crosses this 6088 level, then we have the chances to touch 6102, and if this 6102 penetrates, we may get the level as 6132 and 6180. However, till this low volatility market persists, maximum oscillations we can go till 6075 and minimum oscillation we can come down to 5875, not beyond that, until and unless the volatility has not improved from 12.86 to 15, 16, 20, 25 like that. As long as that volatility maintains that band, we do not have any chances to cross these price levels. Till this point, does anyone has any doubt? If anyone has any doubts till this point, can ask me. I have taken 4 different options, 2 from call option, 2 from put option, and this call option is having a specific behavior. The call options are having in the money nature, one is out of money. Put option also having the same thing. One is in the money, one is out of money. I have taken the average, taken daily volatility. I just wish to take one option strategy for a maximum holding period of 10 days. You can take it 5 days also, 3 days also, nothing wrong in that. Since it is a low volatile market, we will be focusing for the time value decay, hence maximum I can allow for 10 days period. So for that 10 days period, I am expecting Nifty to move by 127 point. However, it has some strong hurdles now. So instead of, though it is a projected by the volatility, but it may not happen, Nifty may oscillate between 6053 to 5896 level, or it may oscillate between 6074 to 5875 level. Successfully, if it crosses 6088, then it has all possibility to rise. Successfully, if it is fallen below this 5862, it has all possibility to fall, or else not. So anybody has any doubts in two strikes of 6100 and 5900, which is not going to penetrate at any cost based on this current volatility, we are assuming these two strikes to form the option strategy. Now look back to the option strategy which is suitable at this point of time. Net credit calendar spread. So think about the net credit calendar spread. So we'll be forming a net credit calendar spread. So which are the strikes we have identified? 6100 and 5900. So take the strikes, 6100 call option strike and 5900 in the lower side. So this put option, we should form the calendar, net credit calendar. So calendar spread, once we are taking 6100 call option net credit. So this is 29 rupees and 90 paisa. 5900 put option we will also take. So which is 48.25. So this is 30. This is 48. So this is for the February. So February we have to sell. Net credit calendar we are forming, and we will be buying the March, same strike March. 6100 is 77 and this is 78, 77 and 78. So this is 77, this is 78. So 6100 call option is 77 rupees, 5900 put option is 78.35, rounded to 78. So by this process, this March, this same strike will be buying. So what happens here? This much of money will be each one lot. So we paid 47 points here. We paid 30 points here. So 30 points we have paid, 47 points we have paid. And calendar spread, as those who are little bit expert in the options, they will be knowing that calendar spread theoretical profit you can't able to project. However, this spread which is currently maintaining at 40 and 30 has the probability to touch near about 105 if the volatility condition, if the volatility move above 25%. Above 25%. If the volatility move above 25%, this spread of 47 and 30 has the probability to touch 105. So both will not touch 105, because if the price is giving a breakout in the 6100 and 5900 below, then that particular part will only give you 105. So this much of risk you can able to take, 47 and 30. This is the maximum loss you can incur, 47 point and 30 point. This is the maximum loss you can incur. However, you have the probability to win near about 65 points in one trade. However, this loss will never, this 47 will never become 0, or this 30 will never become 0. This is also a fact you have to remember. So if this consolidation continues, then you will be getting benefited, and if the Nifty by the end of this settlement cycle, if it is nearing to 6075 or 5875 level, in either case this 47 and 30 spread may, in this low volatility, maintaining this low volatility condition, may go to 80 to 85 level if this consolidation continues. So this is for the net credit calendar spread. Look into the other strategy. So this here you are paying some money. Covered call with put or covered put with the call strategy. So covered call with the put or covered put with the call strategy. So covered call or call means you will be buying a future, buy a future at 5975 level. So we are quoting at 5975. So 5975. Simultaneously, you have to sell a call option. Which strike you have to sell? 6100. Because this is the optimum, this is the point you are going to move maximum by this consolidation period. So 6100 you have sold, and by this process you have reduced the 5975 risk to 5945 because 30 rupees you have received. So nothing wrong if you can buy 5900 put option one lot by paying 48. So what will be your payoff here if it goes to 6100? So here 125 rupees. 125 rupees in terms of the 6100 and future. This gap is 125 plus 30 minus 48. So this will be your net payoff, 107 points. So you can gain. And if this slides below 5862 and come down to 5769 level, so your losses will be 48 plus 45. So 93 point will be your losses if you are taking the covered call. Same way you can take the covered put, selling the future, selling the put option, and same time buying a call option. This is also you can able to take covered call and covered put. So if you wish to take both the things, suppose if you wish to take both the things, covered call and covered put, then future will go off. So you will be landing at a point wherein you can say selling a call option. So if you wish to take both call and put, both the things I should take, so your strategy will look like this. Future will definitely go nullified. 6100 call option you will be selling, 5900 you will be buying, and same time you will be covered put. So covered put, you have to be the same strike you cannot able to take. So you may think of selling some 6000 put option. Sorry, you may think of selling the covered put means you have to sell the put option. So sell 5800 put option, and you have to buy the say 6000 call option. So this also you can do. So this is a short straddle and a long straddle. So this also you can also able to initiate if you wish to take that. Yes, why to take a covered call or covered put, rather take a short straddle and long straddle. Then the third strategy is very interesting. Long conversion with multiple put options long. So long conversion. What is a conversion? Conversion says, long conversion means buy future which is at 5975, sell a call option, call of 6000 nearest strike, and sell a call 6000, sell 6000, put of also put option of 6000. So this convert the strategy to a 6000 put option and 6000 call option. So 65 and 95, so 90 and 65 you can sell it off, and then you should buy some put options with a negative delta. So you need the calculation of delta also. So by this process your future is being protected from the time value decay to the extent of 5820. So nothing wrong if you can buy 5800 put option, multiple lots, 3 to 4 lots, whatever may be the lot. So 5800 put option, multiple lots if you can purchase, then that also will solve your purpose. So this is how also you can able to do. So this is how also you can able to form this kind of strategy. So why we are forming this kind of strategy and what is the essence of forming this strategy? Before coming to these points, I'll just focus little bit on the smart finance products and services. Then after that, I'll tell you those strategy internals. So smart finance, as all of you know, it's having 8 varieties of products. So these courses are investor, technical, Iliad, Fibonacci, GAN, and today you are learning futures and option course. One of couple of strategies you are learning. So likewise we have 8 different variety of products, and one is a pure software. So integrated tool software. It has many advanced option trading tools. I will demonstrate it to you also. So all this having some price tags. Every course is, most of the courses are 1500 except futures and options and volatility, which is 1700 each, and this software is 4500. So these courses are designed in the Indian market and it has added all our research into it. So we have not copied it from anywhere. Rather we have researched, we have formulated our own strategies, we have formulated our own tricks, and that things we have documented in the books, literatures, and some of those concepts also is being programmed. So all our softwares are standalone software. It can run in the computer. It doesn't require any data support. It requires a couple of inputs. You have to give some inputs, then only it will work. I'll demonstrate one also. So this courses is having a total price, if you separately purchasing, it will be 15,400 and the discounted price is 9750. And we used to conduct periodic events like seminar, like one you are experiencing now. Some advanced concept. 17th and 18th, 19th February, we are going to conduct a specific program for pair trading and option strategy, advanced option strategy. So this 3 days of lecture session followed with 3 days of video conference. Through video conference you will be getting the live market practice sessions along with your materials or along with your preparatory lectures, because some basic things you have to learn. What is option Greeks, how to use that option price model. So those basic lectures we will be giving you before. 7 hours lecture will be given to you, and after that this session you will be joining. So these paid events is having a price tag of 12,000 with all material, 4,500 without material, 4,000 for the previous participants, those who have already attended any of our event. So this is about our products and services, and many free stuffs you can get it in our website, as I have told you. So in our website under video segment you will get lot of literatures associated with the investment associated with option trade, intraday trade, WDGAN, technical, Iliad. Lot of video lectures are there. Interesting article section is there, wherein lot of our many literatures associated with the advanced trading technique. We have given it here. You can read through that. And in calculator segment you will get trial version of all our tools. So this tools will produce up to 50% accuracy. However, the paid tools will produce more accuracy. So this is also in the calculator segment. You will get 8 to 9 variety of tools. So the advanced option tool, whatever we are recommending. So here in integrated tool you will find out our advanced option trading tool. So here you will get a intraday option trading tool. In the live session I will demonstrate it. Positional option trading tool you will get. you will get currency futures and option tool. So in the positional option tool, suppose if we are going to 5975, the same way of analysis whatever we have done here. So if I am going to give 6100 strike, which is at a 30 rupees now, calendar days left till expiry, today is 5th and we are expiring on 26th. So 21 days are left till expiry. 21 days are left till expiry. I am going to hold it for 10 days. So call option, if I am analyzing the price trend, so if I'll analyze the price trend, I will get the price trend information here. So we'll be getting the price trend information here. So rather I can take some fresh examples here. So I can take 5975, 6000, and 6000 call option is at a price tag of 65. So 65 call option. So take the interest rate as 12%. Time till expiry is 21 days. I wish to hold it for say 5 days. So I think something wrong with this now. So I am not able to. 28th expiry is in the 28th. Someone is telling me. So let me check it. February. Yeah, 28th. So 23 days are left till expiry. So I am giving the wrong data. I am giving the wrong data. So I am giving the wrong data here. So here 6000, 65, underlying asset is 5975. I have given the wrong data. Future price I have entered here. So 23 days, 28 minus 5, 23 days. I wish to hold for 10 days and call option. So change the interest rate to 12%, considering 1% for month. So this gives you the picture here. As I have explained to you, based on those implied volatility, this gives you the real time implied volatility based on this premium. So NSE side, it will be a historic based on their binomial, based on their Black-Scholes method. Here you will be using the binomial method, which is more accurate. So this says that the initial hurdle, so initial part of this, the Nifty can move to 6028 level and 5922 level. If it successfully crosses this 6027, it has the potentiality to go to 6060. If it crosses that one, it has the potentiality to go to 6083 and followed with 6112 in the coming 10 days period. So these are the levels, 4 different levels Nifty can cross in the 10 days period. However, if it is fallen below 5922, it has all probability to fall down to 5837 level. And during that time, how the premium will behave? So premium may come down to 20 rupees in case of a Nifty fall, or it has the probability to touch this 143 level based on this current implied volatility condition. Apart from that, it gives you how the implied volatility will change during this phase of your migration, and this also gives you all other delta, gamma, omega, vega, theta, all these parameters for your choice. So this tool will help you in making delta neutral. Delta neutral means you can reduce the delta to a comfort level. This can help you for making vega neutral, theta neutral. Many neutral strategies you can able to form by using this strategy, this tool. So this is a very advanced tool, and this will give you a very accurate information for the 3 days, 4 days period. Also you can calculate, you can take down 3 days also. There is nothing wrong in that, Mr. Manish Joshi. You can take why 10 days, you can take 3 days also. So 2 days, 3 days period also you can hold. So all in all, so Just summarize this. What are the things you have learned today? Option strategy for the low volatile market. We have to analyze the trend in the low volatile market. So we have less than 25%. We have kept is the band for low volatile market. So Fibonacci principle will be using to identify the price congestion or the narrow band beyond which the price may not move in this low volatile condition. And we have also learned what are the strategies more effective in this low volatile market. So net credit calendar spread, covered call and long conversion. This is the or short conversion. These are the strategies useful in the low volatile market. So I have given you the explanation here. So I have taken 4 different strike options: implied volatility, average. From there I have calculated the daily volatility. I am going to form the strategy for 10 days period. Because this is a low volatile market, so I have to aim from the time value decay only. So if you take lesser time, 5 days, 3 days, the time value decay component will be very less. You can take 3 days also, nothing wrong in that if you are taking 3 days period. So you will get a different level here. So during the 3 days period, 69 point is expected to move. Out of that, 6018 to 6030 level is the level you can see the consolidation. Maximum 6030, 6030 or 6032, 5920. This is the level you can find out the consolidation. So same way our focus area will also change, 6000 strike and 5900 strike. So in these 2 strikes we can form the strategy for a 3 days objective, and once you are forming it for the 3 days, you should not hold it for 10 days. You must close your strategy within 3 days period. So that also you can make use of. If anybody has any question, can ask me now.